Hi, and welcome to the Real Estate Nerds Podcast. I'm your host, Scott Royal Smith, the owner of Royal Legal Solutions. I'm here with Alpesh today on the special COVID episode, shooting out of the spare bedroom in my house. It's all good and fun, no longer having an office to be able to go into, but we're all making it happen here. So, Alpesh, thanks for joining me here today. And for everybody that doesn't know you, what's important for them to know about you and your journey through real estate investing?
Sure, and thank you so much, Scott, for having me on your show. Sincerely appreciate that. So yeah, a little bit about me. I am a co-author of an Amazon #1 best-selling book, Resilience: How to Turn Your Setback into a Comeback, as well as I am a podcast host. The podcast is called Wealth Matters. It's on iTunes and all other major podcast platforms, as well as I record the podcast and put it on my YouTube channel. So, about me, I started investing in real estate, or I became accidental landlord in 2011. And since then, I have been investing, but I started spending a lot of time in real estate investment world starting 2015. I have invested from single family duplexes to small multifamily, and of course, have moved on to large assets like multifamily buildings, self storage, etc. So, have done a lot of investments in different asset types as well as different markets.
Oh, very cool, man. And I know, we're doing a two-part episode here today where, this first part that we're going to go into is going to be more into the real estate, where we see real estate happening. The second part of this episode, guys, you're going to want to tune into, it's going to be, we're talking about the broader portfolio of investments from how real estate plays a part of a broader portfolio for people, thinking of like, okay, how is this going to work for us here coming out of COVID? So for just the talks about like where are we at with real estate right now, where do you see that there's going to be wins coming up with real estate here in the next, 2 years or so? Where do you think people should be looking to push money to be able to maximize their cash flow?
I would say right now, personally, again, and all of this could change because, the kind of market we are in. No one has seen this before, this black swan event. And I know, Scott, you have been doing some really cool webinars as well on the Corona action plan, etc. So no one has seen this event before where the entire world has shut down, right? So of course there will be effect, right? There'll be after effect of whatever has happened to the economy and overall uh, real estate as well as stock market, etc. Now, just to see how that would affect, because real estate does not go together like stock market. Wall Street is different, where something happens in China or London, the stock market will correct here or would go up here, right? But in real estate world, even though we call it as real estate, there are so many ways for us to invest in real estate, right? Single family residences, multifamily, self storage, mobile home parks, etc., and a lot more. Of course, we'll go dig deep into those during our second episode. But what I'm saying, yes, for sure, certain industries and asset types would get affected. Not every type of real estate would get affected. I'm pretty sure, yes, some of those assets would go 10-20% down. But in next 2 years, I'm just watching this month by month right now. So as of now, I'm hoarding my cash for about next 3 to 6 months. There will be deals definitely in senior housing, in student housing, because pretty good size deals would be there, or discounts. And multifamily, I do see they would go down as well, but not significantly. Again, that would also depend on the market, because what we saw, and we are recording this on April of 28th, right? So this could change, but what we saw with oil market, now that any cities which are highly dependent, or states which are highly dependent on oil, they would definitely see bigger, larger corrections than cities which have diversified economy. Let me put it that way. So we could see Houston's and Oklahoma cities and whatnot could go down further, even in residential real estate as well as multifamily, etc.
And what is it that keys you into thinking more about like student housing and senior living being assets that are going to have big discounts associated with them?
So yes, and the reason is I've been following student housing as well as senior housing, and especially senior housing because I want to invest in senior housing. I know baby boomers are going to be the largest generation in next 2 to 3 years. By 2023, baby boomers will surpass every other type of population, right? So and they are going to need some place to live. What happened because of coronavirus, nursing homes got affected, and now people are reluctant to move their parents, or let's say mom or relatives or whomsoever, into nursing homes, right? So as of now, I would say some of those nursing homes would have vacancies. And personally, we are closing on a senior housing, right? Right now, and even our lender pushed back this month. We were supposed to close on April of 15th, and we have been asked to go do a little bit more due diligence, look at the paperwork again. So we are now working with same lender as well as we have found another lender. So just to look at that perspective as well, just from lending side, it has become so harder because I have personal experience with it. Even though this deal we are working on, it's solid. The numbers, the debt to coverage ratio, DSCR, is 2%. That's unheard of, because lenders require 1.25 in multifamily world to have the DSCR, and we have 2% and 2.0. And then even then the lender wanted to, us to go back and look at the numbers again. The occupancy has not changed in our senior housing project. It's been same for since January of this year, and even then we could see some roadblocks. So I'm worried about the places where there was one coronavirus incident, or maybe none, but in the neighborhood there were some incidents, right? So those nursing homes are getting affected. I could see that, if I had parents where they needed to move to nursing home or assisted care living facilities, I would hold off of that thought for a year or two, right? So that's for senior housing. Student housing, definitely, because students went back home, right? So the occupancies dropped like ridiculously crazy. Occupancy went from 90% or 80 to 90% in certain markets. Because I was just watching, again, I'm not interested or investing in student housing, but the occupancy went from 80, 90% to 20, 30, 40%. That's huge. And if we are not able to find vaccine, of course we can't find vaccine for COVID-19 for till next fall. That's what I've been hearing. But even if we don't have medicine, this could go a little longer. And even if it does not, there will be some students who would be, or parents who would be circumspect about the situation, and they may not send their kids back to school even in the fall semester. So that could get affected as well. And on top of that, the schools or colleges have figured out that you and I are on Zoom right now. Same way they have figured it out, right? Harvard, Stanford, of course I'm taking big names here, but even the small colleges, they are all using Zoom nowadays. So I think of course it would go back again, right? Senior housing and student housing, but in near term, we could see a pretty drastic correction.
Cool. Yeah, I've seen a lot of people like right now, that they're really having to tunnel in a lot of their time into their core businesses to just
Right.
keep them afloat and keep their cash up. And so I'm talking to a lot of people right now where they're telling me about like, hey, I don't actually have time to focus on my real estate investing because I have to focus on my core business, but I have
Right.
to be able to maintain my cash into my core business. Because that's what that's what I've been telling people. I was like, you got to keep your money up.
Yes.
Your
Yeah.
money's got to stay up. Your capital's got to stay up first into it. So I think a lot of people are looking into investing more into syndication deals as they have less time because I'm going to put more time in their business.
Right. Right.
And is that, would you foresee that being like a good place for people to move cash into more syndication style deals around senior housing and student housing, or senior living and student housing?
So I would say I agree to what you just said. Cash is king right now. You got to hoard your cash as much as possible. And of course, but on the flip side, if you do not invest that cash, then you are going to lose out because of inflation. Remember, the government just put 2 trillion plus some, right? Because after 2 trillion, we are close to 3 trillion now, right? So, that money being pumped into the economy, that's going to, devalue our dollar, right? Our buying power. So if we don't invest, we are losing money as well. So, but I prefer, I would recommend that, don't just hoard cash, look at investments, but look at solid investments. Do not be risky. This is not time to speculate. This is the time to be, if someone comes to me and says, oh, you can earn 15% return in this one, but you could lose it all, I'm not going to go for it right now, right? I would prefer, instead of that, I would prefer something solid where it's going to give me 6% return. Again, nothing is guaranteed, but almost guaranteed, where the deals, numbers, the markets look good. Senior housing and student housing, I would wait to invest in those if the deal is now starting. Some of the deals which were already put in place, like my deal where we are acquiring 86 beds and 132 units, that was already there. We had done thorough analysis. Nothing has changed because we spent about 6 months analyzing it. But if someone is putting out a new deal right now, I would not go with student housing or senior housing. I do see that mobile home parks will do good, because even if the economy collapses, right? People still need shelter. People need roof to live. So if they decide to downsize, they are still going to need move to apartment. So multifamily still would be okay, but mobile home parks would definitely do good. And self storage, right? Which we totally forget about that asset, that could do really good, because last recession it did really well. And the reason was that when people had to downsize, they don't want to give up their
Stop.
stuff, their possessions, that even though it may, because they may not have any monetary value, but it has the emotional value to it, right? So those stuff, they tend to put it in the self storage for 30-40 bucks a month, and they forget about it, right? Because it's on auto pay. So self storage is another, and I'm personally looking at mobile home parks as well, some of those assets. And syndication is a good way for someone, and we would discuss about that in the part 2 as well, to diversify. And that's what I believe in, because we have been taught from childhood, and especially when we start working, that you got to diversify your investments in stock market. People tend to forget that when stock market goes down, it goes down together, it goes in hips, right? But you could do the exact same thing in real estate by diversifying your asset. And that's where the syndication model comes into picture, because now you can invest in a market which you know nothing about. You can go with different operators, right? That gives you good diversification, as well as good different asset types, right? So syndication, and I personally invest on my own. I do active syndication, as well as I invest passively in syndication.
Can you talk a little bit about, Alpesh, about your thinking about why to do all three? Because I think a lot of people pigeonhole themselves into one or the other of them. So why is it important for you to be doing all three of those things?
That's a great question. And the reason, and I may be wrong, right? And I may, anger some of the big gurus or syndicators right here. But I believe that, you can invest, you can learn about investment or real estate by investing yourself, right? And that you can do by actively investing. Maybe for some people, it may not be for you at all if you don't have any time whatsoever, right? I mean, some of W2 professionals are working, 60, 70, 80 hours. It may not work for you. But then try to partner with your friend or someone who does this day in, day out. It may not be a syndication model, but at least you would get some idea about how he's managing the asset, etc. So I personally think that by doing it yourself, you learn way more than by investing with others. But by doing it yourself, you are also limiting your investment capability to maybe a market, your local market. Let's say I live in San Francisco Bay Area, and if I didn't have time, I would just buy a property here and rent it out, and that's how I learned. Once I realized that real estate is the way to go, I started investing out of state. See, that's the next state of investment where, I could now, I started building my own team of contractors, property managers, real estate brokers, etc. And started investing out of state in markets like Birmingham, Dallas, Texas, um, uh, Atlanta, Georgia, etc. But the next stage would be that there are, personally, I was tracking 20 different MSAs or markets in US. I cannot invest in every market personally, actively, right? I have to build the team. I have to learn about that market. So that's where the syndication model comes into picture. That if I'm investing in Atlanta, I would go invest with someone else in Las Vegas, Nevada, or Raleigh, North Carolina, because I like those markets, but personally I don't have time to go, dig deep into those markets, build those relationships, right? So that's the passive syndication model. And the active syndication, because I like to scale up also, right? I want to scale up. So that's where, as well as help my friends invest in syndications with me, that's where active syndication comes into picture, because I now bring a deal like senior housing, and I thoroughly analyze the deal, because I'm also putting my skin in the game, plus, my friends' money as well. So I would say if someone does not have time, definitely go with passive syndication model, but go with different operators. Don't go and take your $500,000 or 250,000 and put it with one syndicator in one deal. Instead, try to maximize that and go with the minimum investment. Let's say usually minimum investment is between 50 grand to 75 grand. Go with 50 grand with five syndicators in 5 different markets, in 5 different asset types, right? Because you could go in senior housing, multifamily, office buildings. Yeah, that's another thing. Office buildings would be, you'll find them at great discount. Retail is getting hammered, right? So some of the office buildings, they could get you could find huge discounts soon. So mobile home park, self-storage, as I mentioned, you can go with different operators in different markets. So I like that model, because I'm also definitely reducing my risk, but by reducing my reward, but I'm also learning about each market and capability. And maybe I'll learn about, by doing this, I will figure out that, okay, self-storage and mobile home parks are the 2 of the best assets for me. Or maybe I only want to do multifamily, but with different operators and in different markets.
Very cool, Alpesh. And that's just a wealth of information there. And to just wrap up our part 1 here on your take on that, can you let everybody know where they should be reaching out to you to connect with you in Wealth Matters?
Absolutely. So it's right here, WEALTHMATRS.com, wealthmatters.com. It's shortened, as well as they can check out the podcast on iTunes or YouTube channel, Wealth Matters, or they can email me, alpesh@WEALTHMATRS.com.
Awesome, guys. Thanks for joining us here today on this part 1. Stick around for part 2 here of the Real Estate Nerds podcast. We're going to have Alpesh back. He's going to be talking to us about how real estate fits into a broader portfolio of investments and how he's doing that, and talking about that with Wealth Matters. So go check out Wealth Matters and stick around for part 2.